Have you ever wondered what successful traders actually do every single day? Not the glamorous version you see on social media, not the screenshots of profits, not the luxury lifestyle, but the real routine behind consistent traders. Because here's something most beginners don't realize. Successful trading is not built in the moment you click buy or sell. It's built in the quiet hours before the market opens, during the waiting, and even after the charts are closed. Most people think profitable traders wake up, open their laptop, take a few trades, and the money just flows in. But the truth? Their day is structured, disciplined, and surprisingly repetitive. They follow routines that protect their mindset, sharpen their decision-making, and keep emotions from destroying their accounts. In fact, many legendary traders, from Paul Tudor Jones to Mark Minervini, have often said that routine and discipline matter more than strategy itself. Because in trading, the biggest enemy is never the market. It's impulse, overconfidence, fear, and inconsistency. And that's exactly why the best traders treat trading like a profession, not like a gamble. They don't wake up and ask, "Where can I make money today?" They wake up asking, "How can I execute my process today?" From the moment they wake up, to the way they prepare for the market, to how they review their trades at the end of the day, every step has a purpose. And what's interesting is that when you look closely at profitable traders around the world, you start noticing something powerful. Their routines are different in details, but identical in principles. They protect their focus. They respect risk. They follow a system. And most importantly, they build habits that allow them to stay consistent even when the market becomes unpredictable. Because success in trading is not from one big winning trade. It comes from hundreds of disciplined decisions repeated over time. So if you've ever felt like trading is chaotic, if you've ever wondered why some traders seem calm even during volatile markets, the answer might not be in a new indicator or a new strategy. It might be in how they structure their day. In this video, we're going to break down the daily routine of successful traders, from morning preparation to post-market reflection, so you can see what really happens behind the scenes of consistent profitability. Some of these habits may surprise you. Some may even challenge the way you currently approach trading. But together they reveal a simple truth. Profitable trading is less about predicting the market and more about mastering yourself. And if you stay until the end of this video, you'll not only see how professional traders structure their day, you'll also discover a powerful routine principle that many beginners ignore. One that could completely change the way you approach trading from this point forward. Before the charts even open, before a single trade is placed, the day of a successful trader has already begun. And surprisingly, it doesn't start with the market. It starts with preparation. Most beginners open their laptop and immediately start looking for trades. They scroll through charts, chase sudden movements, and react to whatever the market is doing in the moment. But experienced traders do the opposite. They slow down because they understand something that beginners often overlook. The market always rewards preparation, not reaction. Successful traders treat the hours before the market opens as a mental warm-up. Just like an athlete wouldn't start a game without stretching, traders don't jump into the market without preparing their mind. Some review global market news. Some analyze key levels on the charts. Others simply sit quietly and visualize how they will react to different scenarios. But the purpose is always the same: to remove impulse from the equation. Because when the market starts moving fast, emotions can easily take control. Fear can make you exit too early. Greed can make you hold too long. And excitement can push you into trades that were never part of the plan. Preparation creates a shield against that. It reminds traders of their rules, their risk limits, and their strategy before emotions even have a chance to interfere. Many professional traders also use this time to review their watch list. Instead of scanning hundreds of charts randomly, they focus only on the markets that already fit their strategy. This keeps their attention sharp and intentional. Because trading isn't about watching everything. It's about waiting for the right opportunity. Legendary trader Paul Tudor Jones once said, "The secret to being successful from a trading perspective is to have an indefatigable and undying thirst for information and knowledge." And that's exactly what preparation represents. It's not about predicting the market perfectly. It's about entering the day informed, focused, and mentally ready. Think about it this way. If you enter the market without preparation, you're reacting to randomness. But if you enter with a plan, clear levels, and a focused watch list, every decision becomes intentional. And over time, those intentional decisions are what separate traders who gamble from traders who build consistency. Because the truth is, the best traders rarely feel rushed when the market opens. They feel ready, their levels are marked, their scenarios are clear, and their mindset is calm. So when the market finally begins to move, they're not chasing opportunities. They're simply waiting for the market to come to them. And this simple habit, preparing before the chaos begins, is often the first quiet advantage successful traders build into every single day. Now the market opens, the charts start moving, candles begin forming, prices spike up, drop down, and sometimes move faster than expected. For many traders, this is the moment when emotions begin to take control. The excitement of movement creates a powerful urge to act, and beginners often fall into the same trap. They feel like they must trade immediately. But successful traders approach this moment very differently. Instead of rushing into the first opportunity they see, they slow down even more. They watch. They observe how the market behaves in the first minutes or even the first hour. Because experienced traders understand something that takes most people years to learn. The first move is not always the best move. Sometimes the market is simply shaking out impatient traders. Sometimes volatility is high because institutions are adjusting positions. And sometimes what looks like a perfect setup in the first few minutes turns into the exact opposite direction shortly after. That's why many disciplined traders develop a powerful habit. They wait for confirmation. They wait for price to reach key levels they marked earlier. They wait for their strategy to align. They wait until the market gives them a clear signal instead of forcing one. And while waiting may sound simple, it's actually one of the hardest skills in trading. Because patience feels uncomfortable when everything around you is moving fast. You might see other traders online talking about quick profits. You might feel like you're missing opportunities. But experienced traders understand something important. Missing a trade is far less dangerous than taking a bad one. Legendary trader Mark Minervini once said, "Being a successful trader is about finding a few great opportunities a year and taking full advantage of them." Notice what he didn't say. He didn't say you need to trade constantly. He didn't say you need to catch every move. Instead, the focus is on quality over quantity. And this mindset completely changes how traders behave once the market opens. Instead of chasing every movement, they stay calm. Instead of reacting emotionally, they follow their plan. Sometimes this means watching the charts for long periods without doing anything. And while that might look boring from the outside, it's actually a sign of professional discipline. Because trading is not about how active you are. It's about how selective you are. Successful traders know their edge. They know what conditions must appear before they enter a trade. And until those conditions are met, they are perfectly comfortable doing the hardest thing in trading: nothing. And in a world where everyone is trying to move faster, trade more, and react quicker, the trader who masters the art of waiting often holds the real advantage. Now here's a part of the daily routine that many beginners underestimate. Risk management. Not the exciting part of trading, not the part that people post on social media, but the one habit that quietly keeps successful traders in the game for years. Because once a trader finds a potential setup and prepares to enter a trade, their first thought is usually not, "How much money can I make?" Instead, the question is, "How much am I willing to lose if I'm wrong?" And this kind of thinking changes all. You see, the market is unpredictable. Even the best strategies lose sometimes. Even the most experienced traders make mistakes. Successful traders accept this reality. They don't try to avoid losses completely. They focus on controlling them. Before entering a trade, they already know where their stop-loss will be placed. They already know how much of their account they are risking. And if the trade fails, they accept the loss quickly without letting emotions interfere. This might sound simple, but it's one of the biggest differences between beginners and professionals. Beginners often move their stop-loss further away, hoping the market will come back. They hold losing trades longer than they should, and sometimes a small mistake turns into a devastating loss. But disciplined traders follow a different rule. They treat every trade as a business decision, not an emotional attachment. Legendary trader Bruce Kovner once said, "First of all, never lose money. Secondly, never forget the first rule." And while it may sound simple, the meaning behind it is powerful. It doesn't mean traders never experience losses. It means they respect risk so much that no single trade is allowed to damage their account significantly. Because successful traders understand the truth. Capital is opportunity. As long as your capital is protected, you can always take the next trade. You can always wait for the next setup. You can always recover from small losses. But if you lose a large portion of your account in one emotional decision, the road back becomes much harder. That's why many professional traders risk only a small percentage of their account per trade. Sometimes just 1%, sometimes even less. It may feel slow, but consistency in trading isn't built by one massive win. It's built by surviving long enough for your edge to play out over time. So before they click the buy or sell button, successful traders already know 3 things: where they will enter, where they will exit if they're wrong, and how much they are willing to risk. Once those rules are clear, the trade becomes simple, not emotional, not stressful, just another disciplined decision in a long series of trades. And this habit, protecting capital before chasing profit, is one of the quiet routines that separates traders who last months from traders who last decades. Now here's the part of trading that most people never talk about. What happens after you enter a trade? Because placing the trade is only the beginning. The real challenge often starts while the trade is running. The moment your order is filled, something interesting happens inside your mind. If the trade moves in your favor, you might feel excitement, even greed. You start imagining how much profit you could make if the move continues. But if the trade moves slightly against you, another emotion appears: fear. You begin questioning your analysis. You wonder if you should close the trade early. You start staring at every candle, every tick, every small movement, and this emotional roller coaster is exactly what destroys many traders. Not the strategy, not the market, but the inability to control emotions during the trade. Successful traders understand this very well. That's why their routine doesn't end once the trade is placed. In fact, many experienced traders step away from the screen after entering a position. They already defined their stop loss. They already defined their target. Constantly watching every small movement doesn't improve the trade. It only increases emotional pressure. Instead of reacting to every candle, they allow the trade to follow the plan they prepared earlier. Because once the trade is placed according to the rules, the job is already done. Now it's simply about letting probability play out. Legendary trader Stanley Druckenmiller once shared an important insight about trading discipline. He said, "The way to build long-term returns is through preservation of capital and home runs." Notice the balance in that statement. Protection first, opportunity second. And emotional control plays a huge role in both. Because without discipline, traders often do 2 destructive things. They cut their winning trades too early because they're afraid of losing the profit. And they hold losing trades too long because they hope the market will reverse. Over time, this creates the worst possible combination: small wins and large losses. But disciplined traders reverse this behavior. They accept small losses quickly, and they allow strong trades the time they need to develop. This requires patience. It requires trust in your system. And most importantly, it requires the ability to stay calm even when the market becomes unpredictable. That's why emotional control is not something traders suddenly develop overnight. It's a skill that grows with experience, with self-awareness, and with routines that remove unnecessary pressure. So while beginners stare at every candle, feeling every small movement in the market, professional traders focus on something different. They focus on execution, because once the plan is set and the risk is controlled, the best thing a trader can sometimes do is simply allow the trade to do its job. Now here's a routine that separates casual traders from those who are constantly improving. And interestingly, it happens after the market closes. Because for successful traders, the trading day doesn't end when the last trade is finished. That's when review begins. Most beginners move on immediately. If they made money, they feel satisfied. If they lost money, they try to forget about it. Then the next day, they repeat the exact same mistakes. But experienced traders treat every trading day like a lesson. After the market session, they go back and analyze their trades one by one. They ask themselves, is my strategy have been followed? Is my risk rules have been respected? Did emotions influence my decisions? Sometimes the trade was a winner, but the execution was actually poor. Sometimes the trade was a loss, but the decision was perfectly correct. And this distinction is extremely important, because successful traders don't judge themselves based only on profit or loss. They judge themselves based on discipline and process. Many professional traders even keep a trading journal. They record screenshots of their trades. They write down their reasoning. They document what they felt during the trade. Over time, this journal becomes one of the most valuable tools for improvement. Patterns begin to appear. Maybe you notice you tend to trade impulsively during volatile markets. Maybe you realize your best trades happen only during certain market conditions. Or maybe you discover that your biggest losses come from breaking your own rules. This kind of awareness is what allows traders to refine their edge over time. Legendary trader Peter Lynch once said, "Know what you own and know why you own it." While he was speaking about investing, the principle applies perfectly to trading as well. Every trade should have a clear reason behind it, and reviewing trades helps ensure that those reasons remain logical, not emotional, because trading success isn't built by repeating random actions. It's built by studying your own behavior and gradually improving it. Think of it like an athlete watching recordings of their performance. They're not watching to celebrate. They're watching to understand what can be done better next time. And over weeks and months and years, these small improvements compound. Mistakes become less frequent. Execution becomes sharper. Confidence becomes more grounded. So while beginners focus only on today's profit, successful traders focus on something far more powerful, becoming a slightly better trader tomorrow than they were today. And that mindset, reviewing every trade with honesty and curiosity, is one of the quiet routines that slowly transforms ordinary traders into consistent ones. Here's a routine that surprises many people when they first learn about successful traders. Sometimes, the most productive thing a trader does in a day is step away from the market completely. At first, this might sound strange. After all, if trading is your profession, shouldn't you be watching the charts all day? Shouldn't you be constantly analyzing every movement, looking for the next opportunity? But experienced traders understand something that beginners usually learn the hard way. Too much screen time can actually make you a worse trader. When you stare at charts for hours without a clear setup, your mind begins to search for patterns that aren't really there. You start convincing yourself that a trade might work, even when your strategy says otherwise. This is how overtrading begins. Trade after trade, decision after decision, slowly draining both your capital and your mental energy. Successful traders recognize this danger early. They know that trading requires mental clarity. And clarity doesn't come from forcing yourself to stare at the market all day. It comes from balance. Many professional traders schedule breaks during their trading day. They might go for a short walk. They might exercise. Some simply step away from their screens for a while to reset their focus. Because when your mind is calm and refreshed, your decision-making becomes sharper. But when you're mentally exhausted, even the simplest trading decisions become difficult. Legendary trader George Soros once shared a fascinating insight about how he approaches the market. He said, "When I'm wrong, I change my mind." That statement might sound simple, but it reflects a deeper principle. Successful traders remain mentally flexible. They don't force the market to fit their expectations. They stay aware, adaptable, and clear-headed. And sometimes, stepping away from the screen is exactly what helps maintain that clarity. Because trading is not just a technical skill. It's a psychological one. Your ability to stay calm, your ability to avoid impulsive decisions, your ability to remain patient during slow market conditions. All of these depend on your mental state. That's why the daily routine of successful traders isn't built entirely around charts. It also includes protecting their focus and energy. They know when to trade. And just as importantly, they know when not to trade. Because in trading, activity does not equal productivity. More trades don't always mean more profit. In fact, the opposite is often true. Sometimes the most professional decision a trader can make during the day is simply this: closing the charts, stepping away for a while and returning later with a clearer mind. And this quiet discipline, the ability to pause instead of forcing trades, is another routine that keeps successful traders consistent while others slowly burn out. At the end of the trading day, when the charts finally stop moving and the market quiets down, most people assume the work of a trader is finished. But for successful traders, The final part of the routine is something deeper than analysis or strategy. It's about mindset, because one of the most dangerous things in trading is carrying the wrong emotions into the next day. If you had a big winning day, excitement can easily turn into overconfidence. You start feeling like you've figured out the market completely, and that confidence can quietly push you to take trades that you normally wouldn't. But the opposite can happen too. If the day ended with losses, frustration and self-doubt can begin to creep in. You start questioning your strategy. You start wondering if you're really capable of becoming consistent. And if those emotions follow you into the next trading session, they can influence decisions before the market even opens. That's why experienced traders develop a habit that may seem simple, but is incredibly powerful. At the end of each day, they reset mentally. They remind themselves that every trading day is just one small sample in a long journey. One good day doesn't make you a genius, and one bad day doesn't make you a failure. Legendary trader Ed Seykota once shared a powerful insight about the mindset required in trading. He said, "Systems don't need to be changed. The trick is for a trader to develop a system with which he is compatible." In other words, success in trading is not only about the strategy, it's about the relationship between your personality, your discipline, and your routine. Successful traders understand this. They know that consistency is not built by chasing perfection. It's built by repeating the same disciplined habits day after day, even when the results fluctuate, because the market will always change. Some days will be easy. Some days will be frustrating. Some days will test your patience more than anything else. But routine creates stability in the middle of that uncertainty. It gives traders something to rely on, even when the market becomes unpredictable. And over time, that routine shapes something even more important than profit. It builds confidence in your process. Not the loud confidence that comes from one big winning trade, but the quiet confidence that comes from knowing you followed your rules, knowing you stayed disciplined. Knowing that tomorrow, when the market opens again, you will approach it with the same preparation, the same patience, and the same focus. Because in the world of trading, long-term success rarely comes from moments of brilliance. It comes from something far less exciting, but far more powerful. The daily habits you choose to repeat. As you can see, the daily routine of successful traders isn't built on luck, secret indicators, or chasing every move in the market. It's built on something much simpler and much harder: discipline, preparation before the market opens, patience while waiting for the right opportunity, control over risk and emotions, and the willingness to review, learn, and improve after the day is done. These routines may not look exciting from the outside, but over time they create something incredibly powerful: consistency. And that's the real goal in trading. Not one lucky trade, not one big winning day, but the ability to show up again tomorrow and execute your process with the same focus and discipline. Because in the end, the traders who succeed are rarely the ones who try to predict every market move. They are the ones who master themselves. So if there's one idea to take away from this video, it's this: your trading results are often a reflection of your daily habits. The way you prepare, the way you manage risk, the way you control your emotions, and the way you learn from every single trade. Improve those habits, and over time your trading will begin to improve with them. Now I'd love to hear from you. Which part of this routine do you think is the most difficult for traders? Is it patience, emotional control, or sticking to a plan? Drop your thoughts down in the comments. Your experience might help someone else who's on the same trading journey. And if you found value in this video, make sure to like the video and share it with someone who's learning about trading too. You never know who might need to hear this message today. And of course, subscribe to the channel for more videos about trading psychology, discipline, and the habits that help traders grow over time. I'll see you in the next one.